here is a real life scenario for Chapter 10, responding to fraud risks. So we have appliances repair and service company bills all customers rather than collecting cash when the services are performed. All mail is opened by Tom Guiders, who's the treasurer. Guiders is the CPA and is the most qualified person in the company who's in the office daily. Therefore, he can solve problems and respond to customers' needs quickly. Upon receipt of cash, he immediately prepares a listing of the cash and a duplicate deposit slip. Cash is deposited daily. Guiders uses this listing to enter the financial transactions in the computerized accounting records. He also contacts customers about uncollected accounts receivable. Because he's so knowledgeable about the business and each customer, he grants credit, authorizes all sales allowances, and charges off uncollectible accounts. The owner is extremely pleased with the efficiency of the company. He can run the business without spending much time there because of Guider's effectiveness. Imagine the surprise when he discovers that Guiders has committed a major theft of the company's cash receipts. He did so by not recording sales, recording improper credits to the recorded accounts receivable, and overstating the receivables. So, what weakness in the company's processes permitted him to do this fraud? And then, what suggestions do we have for fixing that? So again, if we think about this and go back to the start of this chapter, we had the fraud triangle. So the fraud triangle said, there's incentive and pressure, there's opportunity, and there's attitudes and rationalization. So we don't really have all of those to know, but so I feel like there's always a point in time in everybody's life where there's probably financial pressure. But then in this case, the big thing that we have here is we have the opportunity. So Guiders would have been doing this day in and day out and was realizing the owner spends very little time, right? He spends very little time because Guider is so effective at his job. So the owner's really not digging in and double checking those things. And so the rationalization by the CPA is either, well, the owner's so stupid, he's not even going to catch me. He doesn't even pay any attention. Or maybe he owes me. I mean, maybe again, because the CPA sees the financials and thinks, this company's doing really well. I'm not getting paid enough, whatever. So that's kind of, again, I like to tie it back to that fraud triangle if we could. But so we definitely at least know the weakness is that there was opportunity. And where the opportunity comes into play is that there's no segregation of duties. He's really it. So when you have that scenario, like I said, I worked at a plastic injection molder that was a small business, and I was that CPA. So I was the person who really did it all. I had a person who worked under me, but I really handled all that stuff. But the difference is the owner of the company was very active, and he would look at stuff. He knew. I mean, he knew what the sales should be. If anything looked out of line, he's going to question it. So he really was involved. So that made it a little bit better than this scenario, because in this scenario, the owner's not even involved. So ideally, though, if you could have more people involved, again, we don't know what employees they have, but even if or so let's say the owner could take all the checks come into him, and then he takes them to the bank and makes a deposit, and then provides that deposit slip to the CPA and lets the CPA record it, but the CPA isn't handling the checks. Or again, if the CPA is handling the checks, then even if the president would then reconcile the bank account or just do something that at least says, hey, I'm double checking some of this work. But in this case, he did not. So the Guiders gets the checks, he makes the list, he enters it into the accounting software. Then he also has the ability to grant sales credits and allowances and write off uncollectible accounts. So then there's no one even double checking that stuff. So he could easily take a check, cash it, and then write it off as uncollectible, or take a check, cash it, write it off as the sales returns and allowances. So to not allow him either some of these functions or have the owner double check, or even to hire just just even a clerical person that has some of those duties, though, such as getting the checks and making those bank deposits daily, would even help right there. So those are going to be some of the advices, but or to require, maybe if there's a sales return, it has to take somebody out in the plant to who or off, if it's a retail environment, whatever it is, some other person to confirm that, hey, yes, I see this product, it got returned, and I'm going to put it back on the shelves. Just something where there's just more double checks in play, because that's ultimately the whole problem, is just that lack of segregation of duties. Okay, so that is our example for this chapter.